of information we were looking for this week, folks, and we got them both. We had a debate, and we'll get back to that. And we had inflation numbers, Brian, and they were as expected. The PPI, which is the measure of more of the producer's price index, came in at what was expected. And so, therefore, it seems baked in that next Wednesday we will get that rate cut. And it's most likely going to be 25 basis points.
That's right. When we've been looking at the data over the last couple of weeks, it's really been a matter of how much is the Fed likely to cut as opposed to whether they will cut. And we've had some pretty critical data releases over the last 2 weeks. It started in the month of September as far as the employment situation report. That was kind of putting the market on the fence as to will it be a 25 basis point cut or a 50 basis point cut. But this past week, we got that consumer price index and the producer price index. Those both, I think, made it such that it almost seals the deal on a 25 basis point cut. It's not to say that they can't do 50 or that they won't do 50, but the evidence isn't really there, I think, to support any sort of bigger move by the Fed, but it does seem like they are set to finally begin that part of the monetary policy cycle of beginning to cut those rates.
And, they've been pretty good and transparent about telling us what they're going to do. And I think if we would see more than 25 basis points, I think they'd be more transparent. I think we can almost bake that in. But, when you take apart these inflation reports, part of that is what's called owner's equivalent rent. What does that mean? What are the costs to own and rent a home? And that continues to be higher than expected, up 0.5%. And at the same time, we're getting these other deflationary news where crude oil begins to go down. So all of these cross currents, folks, are continuing to be out there. And at the same time, Brian, what we're seeing too is that we had a debate and, the markets reacted, as we saw in the betting markets, that Kamala's odds went up almost 8% overnight in the betting market. So a lot of information is out there. Obviously, we live in a 50-50 country, so we can't know for sure how things are going to go. But with those two pieces of information more apparent, the market likes that. They don't like all of this uncertainty.
That's true. Yeah, there's this old saying that the markets don't like uncertainty. And in a way, if you kind of think about it, if there's a lot of that uncertainty, people want to be compensated for it. What does that mean? Well, it oftentimes means prices need to be lower. That's how you get compensated for taking on the risk, is by buying at a lower price. And when you start getting the resolution of the uncertainty, so the uncertainty around when and how much the Fed might cut, and then who might win the election, what the composition of Congress might be. And even if the uncertainty isn't completely resolved, if you begin to get a few indicators about how it might resolve, the market does tend to like that. It's almost like you can adjust, adapt, and move on.
What's going to be interesting as we move forward, Brian, is we've had so much talk about inflation over the last number of years. And of course, we talked about the damaging effect that has had. But crude oil is a really good indicator of what could be happening now. Why is it going down? Obviously less demand in Europe. Obviously, the driving season in the United States is now past. But this is the other thing that we need to pay attention to. China is slowing down, and oftentimes we talk about importing deflation. Explain what that means.
Yeah, so by virtue of importing goods and services from other countries, you can oftentimes get it at lower prices. And if you have a country like China, for many years was viewed as a low-cost producer of goods, then we were able to actually have those goods, but at lower prices. Lower prices equate to lower inflation. So importing deflation, lower prices from other countries, and not just China, others in general, is one of the ways in which you can actually keep overall inflation in the United States fairly low. But when we look at what's been going on in China, it has actually been kind of, I think, a little unsettling to see how slow the government is to react to the slowing growth. Just this past week, I found it very fascinating that they have finally begun to modify a retirement law. So back in 1978, it was set that for retirement for men was at about 60 years old. For women, it was at about 50. And now they're beginning to increase that because of extended life expectancies and the fact that younger generations, their population that is younger than 40 years old, is declining. And so they want to try to bring those people back into the labor force or keep them in the labor force longer. But this is a very slow-moving policy action that isn't likely going to move the needle on growth over there this year or even next.